Gold just hit $3,100 per ounce. The dollar is still the world's reserve currency. Interest rates are still elevated. The U.S. economy is still officially described as resilient. Every traditional signal says gold should be retreating, and yet gold has risen over 35% in the past 12 months alone. That is not a rally. That is a revaluation. The question is not whether gold is rising. The charts have settled that. The question is what the rise is measuring. Because if gold were simply tracking inflation fear or investor sentiment, the move would look different. Retail flows would be leading. Instead, the entities accumulating gold at the fastest rate in recorded history are not hedge funds. They are not retail speculators. They are the central banks of the world's largest sovereign nations. And they are doing something else simultaneously, something in the silver market that almost nobody is talking about. Stay with this. Because the mechanism beneath these two markets will change how you read every financial headline for the rest of this decade. If you leave now, you will miss the only part of this story that actually matters. The confusion is understandable. The financial media is not lying to you. It is simply showing you the surface. Gold goes up. The headline says, inflation hedge, geopolitical tension, safe haven demand. Gold goes down. The headline says, dollar strength, risk appetite returning, rate expectations. The explanation always fits the day. It never explains the decade. The iceberg is the correct model. What the media reports is real, but it is 10% of the structure. The other 90% is submerged, moving slowly, and carrying almost all the weight. And in this cycle, there are two icebergs, one made of gold, one made of silver, moving in the same direction, for different but related reasons. Here is the institutional data point that makes the confusion visible. Between 2022 and 2024, central banks globally purchased over 2,200 tons of gold. That is the highest two-year central bank accumulation figure ever recorded. It dwarfs every previous cycle. And during this same period, the dominant financial media narrative described gold as a relic, a non-yielding asset losing relevance in a high-rate world. The institutions were buying at maximum speed while the narrative said selling was rational. That gap between what institutions do and what the media describes is not noise, it is the signal. The mechanism does not live in the headlines, it lives in the balance sheets and in the industrial order books. That is where this script goes next. The immediate trigger is not one event. It is three structural forces converging in the same 18-month window. And the convergence is what activates the mechanism. First trigger, the U.S. national debt crossed $34 trillion in January 2024. Here is what $34 trillion actually means in human terms. If you earned $100,000 every single day, not per year, per day, starting from the time of Jesus Christ, continuing without interruption through every war, every empire, every century, all the way to this morning, you still would not have accumulated even 1% of the current U.S. national debt. That number is not a political talking point. That is the arithmetic of the whole, and the whole is accelerating. The United States crossed $35 trillion by July of the same year, $2 trillion added in 6 months. At that pace, roughly $1 trillion in new debt accumulates every 90 days. The annual interest payment alone now exceeds $1 trillion, more than the entire U.S. defense budget. Second trigger, the petrodollar architecture, the system established in 1974, whereby Saudi Arabia and OPEC nations agreed to price all oil sales exclusively in U.S. dollars in exchange for American military guarantees, is fracturing at its foundation. In June 2024, Saudi Arabia allowed its 50-year petrodollar agreement with the United States to expire without renewal. This did not make front-page news in most Western outlets, but the structural implications are severe. Every barrel of oil sold outside the dollar system is one less transaction requiring dollar-denominated reserves. Saudi Arabia has since begun accepting Chinese yuan, Indian rupees, and, in bilateral negotiations, gold-linked settlement terms for select energy contracts. Third trigger, the BRICS bloc, expanded to include Saudi Arabia, the UAE, Iran, Ethiopia, and Egypt in 2024, now represents over 45% of global population and roughly 35% of global GDP measured at purchasing power parity. Formal BRICS working groups on a commodity-backed trade settlement currency, referenced internally as a unit and externally as a potential gold-linked instrument, have been active since 2023. 3 pressure points, simultaneous. The cargo ship has begun to turn. Think of the Federal Reserve like a pilot flying a plane with both engines failing. If he pulls up, he stalls. If he pushes down, he crashes. The instruments are giving contradictory readings. And the passengers, the bond market, the housing market, the federal government's debt refinancing schedule, are all depending on him to find a third option that the physics of the situation does not actually allow. This is not metaphor dressed as analysis. This is the arithmetic of the Fed's actual position. If the Fed raises rates further to defend the dollar and control inflation, it increases the interest burden on $34 trillion in federal debt, accelerating the fiscal crisis it is trying to prevent. If it cuts rates to relieve the debt burden, it signals dollar debasement, pushing inflation higher and directly undermining the reserve currency status it is mandated to protect. Every square on the board is covered. The king cannot move. The specific institutional actions are public, traceable, and systematic. The People's Bank of China increased its gold reserves for 18 consecutive months before pausing public disclosure, a pause that institutional analysts interpret as continued accumulation beyond reported figures. The National Bank of Poland purchased 130 tons in 2023 alone, the largest single-year European central bank purchase in recorded history. The Reserve Bank of India added 72 tons in the same period and, in a signal that carries enormous strategic weight, began repatriating gold held at the Bank of England back to domestic Indian vaults. Repatriation is not a trading decision. It is a decades-long logistical commitment. It signals that the institution no longer considers a foreign vault the safest location for its sovereign reserve. That is a statement about geopolitical trust at the highest institutional level. Now add the petrodollar dimension. If Saudi Arabia and Gulf states price even 15% of their oil exports outside the dollar system over the next decade, the recycling mechanism that has sustained dollar demand since 1974 begins to structurally contract. Petrodollars, the dollars earned by oil exporters and recycled into U.S. Treasury purchases, have been one of the primary artificial demand sources for U.S. government debt for 50 years. Remove that recycling mechanism gradually, and the United States must find new buyers for its debt, at higher rates, with greater fiscal pressure, in a world where the institutional consensus on dollar dominance is already quietly shifting. The structural consequence of this convergence is not speculative, it is mechanical, and it involves not one metal, but two. The long-term consequence for gold is not a crash, it is not a spike, it is a melt. The silent, continuous, irreversible repricing of a monetary metal against a currency that is being structurally devalued by the arithmetic of its own debt load. Since 1971, when the U.S. severed the dollar's last formal link to gold, the dollar has lost 87% of its purchasing power as measured against the gold price. That is not a talking point from a metals dealer. It is arithmetic. The official gold price in 1971 divided into the official gold price today. The purchasing power of the dollar, measured in the one asset that central banks are now accumulating at record pace, has declined by nearly 9/10 over 50 years. But gold is only half of this mechanism. Silver is the other half, and it operates through an entirely different engine. If gold is the safety, the monetary reserve, the sovereign hedge, the 5,000-year store of value, then silver is the machine. Silver is what the industrial civilization of the next 30 years is physically built from. A single solar panel requires approximately 20 grams of silver. A single electric vehicle uses between 25 and 50 grams of silver in its electrical systems. Advanced AI server chips, The physical hardware running the artificial intelligence infrastructure being built at trillion-dollar scale globally requires silver-based thermal interface materials and conductive pathways that have no current cost-competitive substitute. The Silver Institute reported a structural silver supply deficit of 184 million ounces in 2023. That is the third consecutive year of deficit, not a demand spike, not a supply disruption. A structural, multi-year gap between what the ground produces and what the global economy consumes. Above-ground silver inventories tracked on the LBMA and COMEX have declined for 4 consecutive years. The available inventory buffer, the cushion between current supply and accelerating industrial demand, is compressing toward levels that historically precede significant price dislocations. Gold moves because sovereigns are restructuring their reserves. Silver moves because the physical infrastructure of the next industrial era is being built from it. And the mine supply cannot keep pace with the construction schedule. 2 metals, 2 mechanisms, 1 direction. The dam is holding more pressure than it was engineered to contain, and now it is holding pressure from both sides simultaneously. The year is 1971. On a Sunday evening in August, President Nixon addresses the nation and closes the gold window. The Bretton Woods system, the global monetary architecture that had governed reserve currencies since 1944, ends in a 15-minute televised announcement. In 1971, the U.S. national debt stood at $400 billion. The debt-to-GDP ratio was 35%. The dollar's share of global reserves was approximately 85%. The Federal Reserve's balance sheet was $90 billion. What followed was the most significant monetary revaluation of the 20th century. Between 1971 and 1980, gold rose from $35 per ounce to $850 per ounce. That is a 2,329% increase across 9 years. Every comparable structural variable is more extreme today, not marginally more extreme. By orders of magnitude, the debt is 85 times larger. The interest burden is 55 times larger. The Fed balance sheet is 80 times its 1971 size. And in 1971, there was no fracturing petrodollar system, no BRICS alternative settlement framework, and no simultaneous structural deficit in the industrial metal that powers the next energy infrastructure cycle. In 1974, when gold was $150 per ounce, analysts called the move an overshoot. In 1978, when gold was $250, the consensus called it a bubble. In January 1980, gold closed at $850. The 1971 structural conditions and the 2024 structural conditions are now side by side. The numbers require no commentary. In March 2022, the average retail investor in gold-linked assets was a net seller. The SPDR Gold Trust, the world's largest gold-backed ETF, recorded net outflows of approximately $3.1 billion in the first quarter of 2022. The consensus retail narrative was rational given the available surface information. In a rate-hiking cycle, a non-yielding asset loses its relative appeal. Sell and rotate to yield. The logic was coherent. The logic was also looking at the tip of the iceberg. That same quarter, the People's Bank of China quietly added to its disclosed gold reserve position. Poland announced a formal strategic gold accumulation target of 20% of national reserves. The Reserve Bank of India initiated the logistical process of repatriating gold from the Bank of England, a process that requires regulatory approvals, shipping arrangements, and vault preparation spanning multiple years. The retail investor sold the mechanism. The institutional player was executing it. By late 2023, as gold approached $2,000 per ounce, retail interest recovered sharply. Financial media articles on gold's rally multiplied. By the time gold crossed $2,500 in mid-2024, ETF inflows had reversed fully. The average retail investor arrived at the mechanism 18 to 24 months after the institutional position was already built. The same pattern is now visible in silver. Industrial procurement teams at major solar manufacturers and EV producers began locking in long-term silver supply contracts in 2022 and 2023. The retail silver market is still primarily driven by coin buyers and short-term traders. The mechanism moves first, the narrative forms second. The retail investor responds to the narrative. Before we get to the signals, tell us in the comments. Did you first pay attention to gold or silver because of a headline, or because something in the underlying numbers stopped making sense to you? No prediction follows. No financial advice is offered here. What follows are three mechanical instruments: publicly available, openly trackable, structurally significant. These are readings on a dashboard. The direction of each reading tells you where the mechanism is pointing. You can verify every figure yourself. Signal 1. World Gold Council Central Bank Net Purchase Data. The World Gold Council publishes quarterly central bank gold demand figures. The data is free and publicly accessible. This single figure, net tons purchased by sovereign institutions per quarter, is the highest level institutional signal available in this mechanism. Purchases above 200 tons per quarter indicate that reserve restructuring is ongoing. Watch the quarterly direction. If that figure holds or accelerates, the structural repositioning has not peaked. Signal 2, the LBMA silver inventory level. The London Bullion Market Association publishes monthly silver vault holding data. This figure represents the physical inventory buffer between current mine supply and industrial demand. When the buffer contracts for multiple consecutive years while industrial demand is projected to grow, solar, EV, AI chip manufacturing, the structural deficit is not correcting, it is widening. Watch the direction of this figure monthly. Declining inventory alongside rising industrial procurement signals that the supply-demand gap is not a temporary disruption, it is a structural condition. Signal 3, IMF COFR Dollar Reserve Share. The IMF publishes COFR data quarterly. The dollar's reserve share has declined from 73% in 2001 to 58% in 2024. Each full percentage point of reserve share that migrates away from the dollar represents trillions of dollars in sovereign asset repositioning. The direction of this trend, not any single quarter's reading, but the multi-year trajectory, is the instrument. If the decline continues at its current pace, the structural demand for dollar-denominated assets weakens. The structural case for monetary metals strengthens arithmetically. This is a reading on the instrument. You can check it yourself. The mechanism in summary. The United States is adding $1 trillion in new debt every 90 days, with annual interest costs that now exceed its entire defense budget. The petrodollar system that recycled oil revenue into Treasury demand for 50 years allowed its foundational agreement to expire in June 2024 without renewal. Central banks are buying gold at the highest sustained rate in recorded history, not as a trade, but as a structural reserve decision. Silver faces a simultaneous supply deficit driven by the physical demands of solar, EV, and AI infrastructure. A deficit now in its third consecutive year. The final image is this: two metals, one message. The monetary system is being quietly, systematically repriced by the institutions that built it. The math does not predict. The math does not advise. The math dictates the direction. Only the speed remains unknown.